Hello, friends. Welcome, all of you. Uh, we are going to start one more new concept today. This is about capital structure theories. In the previous sessions, we have been discussing about the importance of capital structure. We have also discussed what are the determinants of capital structure, how capital structure is important. All these things we had discussed. And you are also aware of this thing that the capital structure planning largely depends on the cost of capital. You also know how this cost of capital needs to be computed. You know how to compute cost of debt, how to compute cost of equity, and how to arrive at the weighted average cost of capital. That also you know. So let us start with our today's topic, that is capital structure theories. For that, I will be sharing my screen with you right now. So if you look at your screen, you can understand. I can showing you some of the capital structure theories. One is net income approach, net operating income approach, then traditional approach, the approach. These are four popular capital structure theories we are going to learn. There are other theories are also there beyond this theory, but they may not be relevant for your syllabus point of view. So these are the four theories we will be learning. First, let us understand what are these theories. These capital theories, our capital structure theories, will be telling us whether this capital structure will be affecting the value of the firm. And when I say capital structure, I mean a combination of debt and equity. That means, in essence, what I'm talking about. I'm talking about whether introduction of debt in the capital structure is affecting the value of the firm or not. Okay, that is what we are impact on. So if there is no debt, that means what? It's a zero debt company. Okay. And if debt is introduced, debt, is a cheaper form of finance. Cost of debt is cheaper. If a cheap form of finance is introduced in the capital structure, normally we expect the value of the farm should go off. But it is a difficult thing to decide that how much debt needs to be introduced. Debt is cheaper, but debt is also risky. So one need to draw a balance between this cost as well as the risk involved. When debt is introduced, it brings leverage in the capital structure. Leverage concept, it brings leverage in the capital structure means that by putting less effort, you will be getting more reward. Your rewards will be disproportionate to the effort. That is what we call it the leverage. A farm which is having debt in its capital structure is called as levered farm. And the farm, when there is no debt in the capital structure, that means an all equity farm, can be referred to as an unlevered farm. And the value of the farm shall be the value of the shares plus the value of debts. In short, we can say V is equal to S plus D. This is what we have to remember. Capital structure theories. And all the four theories that I showed you, they have got some common assumptions. Let me first take you through these common assumptions. First assumption is there on the screen, and you will agree to it because many times I had explained you this thing, that debt is cheaper than equity. Cost of debt is low than cost of equity because you get tax shield, and the person who are investing in debt or the lenders are taking less risk. So their expectation is less, so cost will be less. Next assumption is that there is no tax rate. While testing these theories, we'll assume that there is no tax and all earnings are distributed in dividend. That means there is no retention. Also, we are assuming that growth is equal to zero, P is equal to zero. So, friends, when you have studied the formula for computation of growth, you have already seen one formula was there where it was saying that G is equal to V into R, where V is the retention ratio and R is equal to return on equity. So growth is a function of retention and return. And when retention is zero, why retention is zero? In the previous point, we have assumed that everything is distributed. That means there is no retention. So when retention is zero, that zero get, if you multiply with return on equity, it will become zero. So therefore, growth will become zero. So when all dividend is distributed, growth is zero. Then the theory is also assume that without incurring any transaction cost, a firm can change its capital structure. That means if you want to convert debt into equity, or if you want to introduce more debt by reducing equity, if you want to make this kind of changes, it will not involve any transaction cost. So that you can freely decide that what kind of capital structure uh, you would like to change. Right? These are the assumptions. Now, some of the formula also will remember. First of all, you know most of this formula. You know the cost of debt is equal to interest by value of the debt, or I by D. From this formula, we can derive if KD is equal to I by D, what is debt? Debt is the value of debt. D is the value of debt. If KD is equal to I by D, then D is equal to I by KD. Derived formula. So the value of the debt is equal to interest by cost of debt. Similarly, cost of equity is equal to earning before tax divided by shares, value of the shares, or value of the shares is equal to earning before tax divided by KE. This is also, you can come, this how you can compute the S or share value. And overall cost of capital, or KO, is equal to earning before interest and taxes by V. Or you can say V stands for value. Value is equal to EBIT by KO. Or you can also say V is equal to D plus S. That is value of the farm is equal to value of the debt plus value of the shares. So these formulas are important for us. We'll be using this formula to analyze our theories. Now, almost similar kind of formula, same formula, I'm putting it in one place. So cost of debt, KD is equal to interest by market price of debt, or debt is equal to interest by KD. I think you are able to understand. Coming to cost of equity, the formula is that we have already seen this formula D1 by V0 plus G. And if you solve it, you can find out that V0 is the value of the shares, or S of V0 is equal to D1 by KE minus G. So P0 is equal to D1 divided by KE minus G. The overall cost is equal to cost of debt plus cost of equity. So overall cost is equal to cost of debt KD multiplied with D by V. D by V means debt by total value, that is total capital. V is equal to S plus D already. So cost of debt multiplied with the proportion of debt in the capital structure plus cost of equity multiplied with the proportion of share in the capital structure. So KD into D by V plus KE into S by V. And this D and S, if you take together, it will become your V. Okay, right? Understood. So cost of debt into debt by total value plus cost of equity plus share by total value. This is how we'll compute overall cost of capital. Overall cost also can be computed by using the formula EBIT by V. V is the total value. EBIT is to be distributed to the interest. EBIT means earning before interest and taxes. Tax will go to the government, but the earning interest will go to the debt holders, and remaining earning will be distributed to the shareholders. So KO is equal to, and here we are assuming there is no taxes. So entire EBIT will go to the debt holders and shareholders. So that becomes the cost for the business. So overall cost is equal to EBIT divided by value. Overall cost is also can be computed like this, that KD into D by S plus D plus KE into S by S plus D. Same formula here. Instead of taking V, earlier you see you have taken this formula here. Instead of taking V, we are taking S plus D, as you know that V is equal to S plus D. We are aware of. Just have a look at this formula. You'll be able to understand it. Okay. These are the formula. Now here I'm showing you a structure to give you some idea that how EBIT is computed. You see, the structure says first we'll arrive at the revenue minus operating expenses. You'll be getting profit before depreciation, interest, and taxes. That is called as PBDIT. Okay, less depreciation, you'll be getting PBIT or EBIT. This PBIT is important because this is the money which will go to the shareholders as well as the debt holders. Entire money is the cost. First, you'll pay to the interest the debt holder, so minus the interest. You'll be getting PBT. PBT will go to the equity holders. Tax here it is assumed to be zero. So earning will be or earning profit after tax will be the same. Okay, this is the structure you need to remember. From this formula, you can understand that how KD is computed. KD is the interest rate debt because this money, whatever is interest, that will be given to the debt holders. KE is equal to D1. That D1 means dividend or earning after taxes divided by equity value. Just have a look. So this understanding will be helping you to develop the formula of your own. And the overall cost, KO, you know, is EBIT by value because this is EBIT. EBIT, the entire money is distributed to the debt holders as well as shareholders. So KO is equal to EBIT by value. Okay. So we have already seen the common assumptions to all the four theories. Now there are some specific assumptions to the first theory. Assumption specific to net income theory. You see. Assumption is that debt cost is constant, irrespective of leverage. Irrespective of leverage means what? Irrespective of leverage means that whether you are having zero debt or you are having a substantial amount of debt, that means whether you are having a small debt or a big debt, that doesn't matter. But cost of debt will remain constant. For example, let us say you have got a small debt of 5,000 rupees. If debt cost is, let us say, 10%. Even if you are having a debt of 5 crore rupees, debt cost will also be 10%. This is the assumption. Then it says cost of equity is also constant, irrespective of leverage. That means again, leverage doesn't matter. Irrespective of leverage, irrespective of the proportion of debt in your capital structure, cost of equity is also constant. So these are the two additional assumptions. With these assumptions, now let us learn our theory. First, I will give you some explanation about this theory. Then I'll be showing you how this theory works. Very simple theories. Financial management theories are relatively simple, but you need to pay attention to understand them. First, what this approach says. This approach says, as the proportion of debt increases in the capital structure, the value of the firm increases. So that means what this particular theory is saying is very simple. That means if you increase the proportion of the debt, value of the farm will increase. मतलब simply वो ऐसा बोल रहा है कि आपका डेप्थ का proportion बढ़ा दो, farm का value बढ़ जाएगा. Why it is so? This is because when increasing the proportion of debt, debt is cheaper, you know. When debt is cheaper, so you will be arranging more cheap funds. आपको सस्ते में पैसा मिल जाएगा. So that will benefit farm's value will increase. This is because the overall cost of capital will decrease. In other words, you can say introduction of a debt has an impact on value of the farm. That means introduction of debt is relevant for the company. Okay, so debt needs to be introduced. That is what these theories say. Now you look at what I'm showing you. Many of you can understand. It's a dish. Aloo or gobi ka sabzi. Here is another dish. इसमें कुछ समझ में आ रहा है आपको क्या डिफरेंस है? सो एक को आप अगर कहेंगे गोभी आलू तो दूसरे को कहेंगे आलू गोभी, क्योंकि एक में आलू ज्यादा है गोभी कम है, दूसरे में गोभी ज्यादा है आलू कम है। ओके, one is costly, another is cheaper. So if I introduce cheap fonts, let us say यहाँ आलू में ज्यादा डाल, गोभी थोड़ा निकालते हैं, गोभी कम रहेगा, तो what will happen? So overall cost will come down. Exactly same thing we are doing in capital structure. Alu is like debt. Gobi is like your equity. Gobi is more costly, equity is more costly. So if I increase the proportion of alu, तो सब्जी तो सस्ते में बन जाएगी। इसका मतलब आपको सस्ते में कैपिटल मिल जाएगी, आप अच्छा बिजनेस कर पाओगे, अच्छा प्रॉफिट कमाओगे। So that is the importance. Okay, now if you understand the theory says like this. First, it is assumed that cost of debt remains constant irrespective of leverage. The bottom line, if you see this line is, let me go back. This bottom line, it talks about leverage. Here, if I stay here in the corner, that means leverage is 0. Then leverage can be 10, 20, that means more debt. So more debt means, now here I am showing that irrespective of leverage, that means what is the proportion of debt to share, it doesn't matter. You are having 10% of capital in the form of debt or 20%, 30%, 40%, 50%, doesn't matter. Irrespective of leverage, cost of debt will be cheaper. Cost of debt will be constant. Similarly, irrespective of leverage, cost of equity, this green line, will also be constant. The theory says cost of KD is constant, KE is constant. And KD will always stay lower than KE because KD is less, KE is. If this situation, this theory says, as you keep on increasing the debt, suppose आप debt बढ़ाते जाओ, so your overall cost capital will come down like this. So KD is constant, KE is constant, but KO will fall. Why it will fall? Because you are changing the proportion. You are changing the proportion. You are shifting your high cost capital, or you are converting your high cost capital, that is equity, to low cost capital, that is debt. अब डेप्ट बढ़ाते जा रहे हो, इक्विटी घटाते जा रहा हो, इक्विटी सस्ता है, सॉरी इक्विटी कॉस्टली है, डेप्ट सस्ता है, तो ओवरऑल कॉस्ट तो कम हो जाएगा. So that is the thing. Okay. So the conclusions of net income theory is that as the proportion of debt increases, KD and KE being constant and KD being lower than KE, KO falls. KO means overall cost of capital will fall, it will go down. When overall cost of capital goes down, the value of the firm increases. This theory recognizes that debt has got a positive impact. Debt is relevant for the capital. Since a costly fund source of funding, that is equity, is substituted by a cheaper form of funding, that is debt, the overall cost capital will go down. This means optimal capital structure is one which results lowest KO. Jahan overall cost of capital is सबसे कम है, that is the optimal capital structure. This is what the theory suggests. Friends, I will show you an example here now. Let us say there are 3 firms. All of them are having EBIT. EBIT means earning before interest and taxes of 20,000, 20,000, 20,000 each. Interest is 3,000, 6,000, 9,000. That means firm A is having low debt because interest is low. Firm B is having moderate debt. Firm C is having high debt. And in all the 3 cases, KE is 10%, KD is 6%. Compute the value of the firm. Just have a look at this picture. Just have a look. And we'll be solving this question. Just have a look. We'll be solving this question after the break. Just think how to solve it, how to arrive at the value of the firm. You can take a snapshot of this and try thinking. Okay, friends. Let me take a break for 10 minutes, then we'll catch up and solve that question. Thank you.